Hello time travelers, we recently launched the Liquidity Addition feature to Timeswap, and this walkthrough will guide you on how to use the dApp and also answer most of your questions around it. Now the first question you might have is why become a liquidity provider in the first place? Just like an LP on Uniswap, you as a liquidity provider are rewarded for providing liquidity with a share of the transaction fees paid by lenders and borrowers. Currently, the transaction fees is 1.5% annualized for lenders and borrowers, and the LP revenue is 5 by 6th of the transaction fees generated in the pool. Now let's get started. Click on the Liquidity tab of the dApp. Here you are asked to select asset and collateral for the pool you want to add liquidity. Let's go with the currently active USDC Matic pool expiring on 8th July 12 pm UTC. So I will select USDC as an asset, collateral as Matic, and the maturity date to be 8th July 12 pm UTC. This pool currently offers 5.5% APR and 106.73% CDP respectively. An LP in Timeswap is a market maker acting both as a lender and borrower. You can think of it this way. LP adds assets so borrowers can borrow and adds collateral for lenders' insurance coverage against default risk, hence making markets on both sides. As an LP, you enter the amount of assets you want to add to the pool. The collateral to be locked will be prompted automatically by the protocol. You can enter either asset or the collateral and the corresponding amount will be automatically calculated. Now, once I confirm the transaction in MetaMask, a liquidity position appears below which shows the share of pool liquidity I own. Since LP is also a borrower, I can see my borrowing position which is accessible from the borrowing dashboard. Do remember that LP's liquidity can be withdrawn only after maturity. However, a portion of the collateral can be withdrawn prior to maturity by repaying the debt using the flash repay mechanism, which we will explain shortly. In the current pool, LP liquidity can be removed only once the pool matures on Friday 12 pm UTC. As mentioned earlier, Timeswap LP acts both as a lender and a borrower. For the borrowing part, the LP has the optionality to repay the debt and withdraw collateral that has been locked. However, this requires additional capital to be brought in by the LP to close out the debt. To address this, we have also enabled a flash repay option for the LP, wherein they can use the flash swap functionality of the DEXs to instantly repay the debt and pass the remaining collateral back to the LP. Let's check out how this works. Given my collateral value is more than my debt, once I click the flash repay button, the collateral is swapped for the asset amount equivalent to the debt on a DEX, and remaining or surplus collateral after repaying the debt is deposited into the LP's wallet. Do note that the flash repay option only works if collateral value exceeds debt value. Now, is it necessary to use flash repay? We've got this question from a lot of time travelers. When do you repay? You should repay the debt if it makes sense. In other words, when collateral value is more than debt. Using flash repay is beneficial because there's no need to bring in additional asset token to repay. Rather, your collateral is utilized to repay the debt. What happens to your liquidity if flash repay is used? Your share of LP token essentially gives you the claim to liquidity which is left in the asset pool and collateral pool at maturity after the lender's settlement is complete. So when I burn my LP token, I get a proportionate share to the remaining asset, that is USDC, and collateral, that is Matic. To sum it up, flash repay and burn liquidity are two independent transactions. One is used to repay the debt and the other is removing liquidity after the pool matures. So that's it from our side. If you have any questions, feedback or suggestions, please feel free to hop on our Discord and share them with us. Thank you for watching.